Today, is the mortgage market in for a shock? The DFA Daily to the 9th of August 2021. Hello again, it's Martin North from Digital Finance Analytics, World latest post covering finance and problem news with a distinctively Australian flavour. Today we look at the latest signs concerning pressures on the mortgage market, and this despite the RBA's deflection that home prices has nothing to do with them. It does appear mortgage tightening is on the cards. Perhaps the only question is whether the regulators will pull the trigger before or after next year's federal election, which of course is due in May. And meantime, loan deferrals are rising as the lockdowns run. Yet much of the pressure is being felt by renters, according to a recent survey, plus small businesses, while real estate companies like REA have been making hay in the booming market. The Australian reported today that APRA is becoming increasingly concerned about the frenzied pace of mortgage lending and has written to banks to put them on notice. The letter from the head of the Australian Prudential and Regulation Commission sent to the boards of the biggest banks warns lenders to be especially vigilant in managing the risks within their residential mortgage portfolios in the current environment. The letter, which was released under Freedom of Information rules, also gave bank boards just weeks to sign off on assurances that lending growth across the sector wasn't reckless. APRA Chair Wayne Byres had told the banks in the letter, which is dated April the 23rd, that the lending growth is coming in a backdrop of extraordinarily low interest rates, high household indebtedness, and accelerating housing prices. Well, it's interesting he didn't make any of those mentions last time he was in front of the Parliament. While borrowers were expected to have serviceability buffers in place, it was important that excessive debt levels are not being incurred by customers during a period of exceptionally low interest rates, Mr. Byres said. The chair of the Council of Financial Regulators, the Reserve Bank of Australia Governor Phil Lowe, also told a parliamentary committee on Friday that he couldn't rule out regulators taking action to curb excessive household credit growth over the coming year. APRA at some point would be preparing interventions. The RBA has previously indicated that it has been monitoring both the housing and mortgage markets, working with APRA to collect data on the banks and talking directly to the financial institutions. But Lowe reaffirmed last week when he discussed the cash rate decisions, stating it is important that lending standards are maintained. But speaking to the House of Representatives Standing Committee on Friday, Dr. Lowe said he is yet to see any signs of deterioration in lending standards. We're not in a situation we were in last decade when almost half the loans in the country were being made without $1 of principal having to be repaid on a regular basis. These were the interest-only loans. And you'll recall last decade there have been very dramatic boosting in lending standards for investors, Dr. Lowe said. So we're not seeing that. And we're not seeing the interest-only loans. And we're not seeing underwriting standards. We can pause there. Just remember that over the last few months, a number of people were encouraged to switch to interest-only loans to make repayments more palatable. So Lowe is actually not right. The RBA has signalled that it would take action alongside APRA if it deemed lending growth too strong, with high rates of debt-to-income growth. While Dr. Lowe was reluctant to set benchmarks for intervention, he commented that it would be necessary if credit growth picked up materially from where it currently is. Let's say we're talking double-digit credit growth sustained for a period of time, and income growth is running at 4 to 5%. That would be problematic in my view, he said. At some point, APRA would be considering interventions. At meetings of the Council of Financial Regulators, APRA and the RBA, and of course the Treasury as well, have considered tools such as raising the minimum interest rate that banks use for home loans, which would squeeze how much they could lend to individuals. And Dr. Lowe also mentioned potential portfolio loan-to-value restrictions or debt-to-income restrictions. We're not at that point where these restrictions are needed, but I cannot rule out that point emerging within the next year. Time will tell. To which I respond, just look at the data. It's there in plain sight if you want to see it. Meanwhile, New Zealand Central Bank will soon begin consulting on ways to tighten mortgage lending standards amid concerns around a rise in risky lending. And in fact, I caught up with Joe Wilkes today and we discussed New Zealand, so go have a look at that show. We can't control house prices, Lowe says. He refuted claims from Labour MP Andrew Leigh that the Reserve Bank should implement formal research and analysis of house prices amid the ongoing rising trend. Ultimately, the main drivers of housing prices over time aren't within our control, he said, which is absolute rhubarb, by the way. Interest rates are pushing up housing prices at the moment, and their influence is global. But in the end, if society wants to do something about the overall level of housing prices, the solution isn't higher interest rates, he said. Oh dear. Well, once again, of course, we're seeing in the situation where the true reality is that more credit stokes house prices, therefore less credit eases house prices. And the research at the RBA said 100 basis point off interest rates equates to about a 30% rise in prices over the midterm. I don't understand who can make that argument. If we had higher interest rates now, sure, housing price growth would be lower, but fewer people would have jobs and wages would be lower. So that's not an attractive trade-off, and it's certainly not one the Reserve Bank has a mandate to make. He added the tools to tackle house prices are not in the central bank's hands, but rather they're in the government's. And it's about urban design, planning laws, transportation. We've got to keep an eye on it, but I'd rather my staff do work on things that can directly influence decisions that we can take, rather than decisions that others could take, he said. And just think about this. What Lowe is doing is misdirecting. He's basically saying it was better to have lower levels of interest rates and higher levels of employment and hang house prices. I can't agree with him. Also, the RBA did note a strong economic recovery following Australia's recession last year, but the recent outbreaks and lockdowns are likely to reverse some of that progress during the September quarter. How large that decline will be depends on the duration of the lockdowns and whether there are further material outbreaks elsewhere in Australia in the weeks ahead, Dr. Lowe told the committee. As a rough rule of thumb, household consumption in areas in lockdown is typically around 15% lower than it otherwise would be. In addition, the lockdowns have directly affected construction activity in New South Wales, and they've delayed some investment plans. An increase in unemployment rates is also expected over the months ahead, although most of the adjustment in the labour market is likely to be through a decline in hours worked and participation rate, rather than in job losses. Sydney is calculated to be losing around $1 billion a week, according to RBA modelling, as Treasury has released recent estimates that nationally the lockdowns are costing the economy around $3.2 billion per week. However, the RBA is optimistic that the economy will bounce back quickly once the areas affected exit lockdown. Consumers are expected to go out and start spending at previous levels again once restrictions lift, although Dr. Lowe cautioned the longer the lockdowns last, the more likely sentiment will deteriorate. Further, not all of Australia has been hit by the recent outbreaks. It's important not to lose sight of the fact that not all of Australia is affected. Significant parts of the Australian economy is still on a positive trajectory that was in place before the outbreak, he said. This is quite a different picture from the situation we were in the first half of last year, when the whole of Australia was in lockdown. So at least at the moment, it's still a mixed picture. Now, according to the Australian Banking Association, almost 24,000 customers have accessed hardship support from banks since early July, with 64% opting to defer loan repayments for up to 3 months, according to new data. Figures have revealed that more than 23,000 customers have received hardship assistance during recent lockdowns, including just over 15,000 repayment deferrals on home and business loans. Since the 8th of July, more than 14,500 home loans and 600 business loans have been deferred across Australia. Comparatively, during the peak of the coronavirus pandemic in 2020, almost 500,000 home loans and more than 225,000 business loans were deferred. Hardship approvals and loan deferrals have been heavily skewed towards New South Wales residents due to the current lockdown, which is due, of course, to continue at least until the end of August, and so could certainly extend further, depending on vaccination rates and case numbers. Home loan deferrals in the states have accounted for more than 2/3 of total deferrals, while almost 80% of deferred business loans are also from New South Wales. Data from the Big Four banks and Bendigo Bank shows that between the 8th of July and the 1st of August, there were over 10,400 home loan deferrals and 483 business loan deferrals in New South Wales. Across the other states, Victoria had the second highest number of home loan deferrals at 2,580, but only 76 deferred business loans. South Australia had 620 deferred home loans and 16 deferred business loans. Queensland had 501 deferred home loans and 22 deferred business loans, and Western Australia had 245 deferred home loans and 6 deferred business loans, while the ACT had 61 deferred home loans and 3 deferred business loans. Tasmania had 47 deferred home loans and 6 deferred business loans, and the Northern Territory had 30 deferred home loans and no business loans deferred. Growth in housing loan deferrals slowed from 344% the week prior to 79% last week, but the growth in business loan deferrals grew from 93% to 108%. The number of customers accessing hardship grew by 73% last week, which is a slower rate of growth from the week prior, when it grew by 153%, according to the ABA. And the ABA CEO Anna Blight urged customers not to tough it out on their own and seek assistance from their lenders. She said lockdowns continue to bite across several states and banks are again stepping up to help. Support is available to all small business and home loan customers significantly impacted by current lockdowns or recovering from recent lockdowns, irrespective of geography or industry. The major and non-major banks recently expanded on their existing COVID-19 support measures to provide home loan support, including deferrals on a month-by-month basis and business banking repayment deferrals for up to 3 months, with loan terms extended as required. Business loan deferrals are applicable to business lending less than $3 million and a turnover of less than $5 million, and is only for loans in good standing, i.e. repayments are up to date or engaged in a repayment program with their bank. The Australian Prudential Regulatory Authority recently extended regulatory relief for banks, offering temporary financial assistance to customers impacted by lockdowns, stating that banks will not need to treat the deferred period as an arrears period in a loan restructuring. So in a way, further support for the banks directly and indirectly. Mortgagees are paying a smaller proportion of their income on home repayments compared to renters on rental payments, according to research from Any Bank, who found that over 2/3, in fact 68% of renters reported rent stress, which is typically considered to be rental payments of more than 30% of household disposable income, except if you look at my research, where I look at on an individual cash flow basis, of course. Fewer respondents reported mortgage stress, with 42% of mortgagees paying more than 30% of their household disposable income on mortgage repayments. Now that's an interesting figure because my number also came out at around 42% on a completely different basis. So this is actually a significant correlation between my data sets, which looks at cash flow, and another assessment from ME Bank, which looks at a different way. 42% of households, nowhere near what the mainstream were claiming. The survey of 1,500 households in June 21, with the assistance from DPN Consultants and Economics and Beyond, found on average renters are spending 41% of their income on rent. That's jumped by 8% over the last 6 months to June 2021. The current level of rental stress is 3% higher than that measured in December 2019 before the coronavirus pandemic. And the proportion of renters reporting no stress reduced from 40% in December 2020 to 32% in June 2021. Those reporting some stress increased from 21% to 25%, and those reporting moderate stress increased from 26% to 29%, and those reporting a lot of stress increased from 12% to 15%. Groups that reported high levels of rent stress include single parents, couples with young children, retirees and households on low incomes, less than $40,000 per annum, and below the average income of $40,000 to $75,000 per annum. Further, more women, actually 75%, reported rent stress than men at 60%. Commenting on the survey findings, ME Bank's consulting economist Jeff Orton said that a range of factors had contained mortgage stress more than rent stress, including low interest rates, a recovery in economic activity, and loan repayment deferrals by some households. Furthermore, households are well ahead of their minimum repayments and have significant net equity or savings in their home loans, Mr. Orton said. On the other hand, rental markets have significantly tightened across most of the country, while falling vacancies have resulted in steep rent rises, he said. As at June 21, the median rent of houses and units had jumped by 6.6% compared to the same time last year to $476 per week, according to CoreLogic data. Renters are now facing some of the biggest rent hikes we've seen since the global financial crisis, Mr. Orton said. While wages gain on average have picked up slightly from a historical lows recorded at the onset of the pandemic, government income support has gradually unwound and rental moratoriums have ended. We may see more renters facing hardship as lockdowns continue, particularly among low-income, low-saving households reliant on government support. And ME Bank's findings have followed the recent release of a report by CoreLogic that said that servicing mortgages have become cheaper than paying rent on 36.2% of properties, which is higher than the pre-COVID-19 proportion of 33.9% as February last year. And I would just underscore the fact that I also see much higher levels of both rental stress and mortgage stress amongst young growing families, where it is extremely difficult to maintain cash flow in the current environment, particularly if you are a recent first-time buyer with a very large mortgage. Now, MPA reports that self-employed borrowers are the ones hurting the most as the nation's two largest economies remain in lockdown, according to Theo Chambers. The CEO of top Sydney brokerage Shaw Financial spoke to MPA at a time when construction across Greater Sydney was banned and South Australia was preparing to join Sydney and Melbourne in lockdown. Since then, Southeast Queensland has locked down, South Australia has opened up, and Victoria has re-entered lockdown after 9 days of no stay-at-home orders brought a handful of mystery cases to the fore. While state and federal governments have introduced and adjusted various business support mechanisms for those impacted by the restrictions, small businesses affected by those lockdowns are still suffering. And it's not just those in non-essential retail or construction that are feeling the brunt, said Chambers. When the construction industry gets hurt, then all the supplementary industries get hurt with it, he said. We've got clients in wholesaling for food and alcohol, and when restaurants are shut, their businesses get hurt because they are supplying the restaurants. While the Greater Sydney ban on construction has been tapered to a ban on construction in the city's 8 LGAs of most concern, a survey of members by the Master Builders Association has shown that 2/3 of construction companies experienced more than a 50% drop in work in the week the sector reopened. And a study by the Urban Development Institute of Australia revealed that 1/3 of Sydney's construction sites remain closed and that open sites are operating at 50% capacity. But while pausing repayments or having access to more finance will help many who are impacted, it will also increase their debt obligations, said Chambers. This also applies to the government stimulus that has been brought out. The country is getting into debt to fuel growth, which has implications, he said. And the US inflation has gone through the roof on this quantitative easing we're doing right now. Some businesses get hurt permanently from these things, lockdown restrictions, of course, we're talking about there, and the ripple-on effect from people having to eat into savings during times like this to pay the extra rent or pay for expenses while no income is coming in. It really hurts the self-employed business owner the most. I feel it's like kicking the can down the road of a bigger global economic problem that might arise of this debt crisis that a lot of people talk about. And finally, ASX-listed REA Group, the Mortgage Choice Smartline parent company, has reported an 18% increase in net profit driven by a strong residential market recovery. ASX-listed REA Group The digital advertising business specialising in property, which operates realestate.com.au, has announced its results for the year ended the 30th of June 2021. According to the group, it saw a 13% increase in year-on-year revenue growth to $928 million and an 18% rise in net profits of $318 million. When excluding the impact of acquisitions such as the recent Mortgage Choice acquisition and Simpology stakeholding, revenue increased by 11% for the year, bolstered by increased subscription revenues and growth in add-on products, with net profits after tax at 24%. According to the group, the growth reflected a strong residential market recovery despite significant first quarter listings declines in Melbourne due to COVID lockdown measures. This led to higher national listings with record visits to the listing site amid strong appetite from buyers. The results also reflect growth in its financial services revenue. The operating revenue of the financial services business, which now comprises both Mortgage Choice and Smartline in its soon-to-be-renamed combined broking business, increased 9%, driven by higher settlements, increased broker recruitment and improved productivity. The financial results showed that broker submissions, excluding Mortgage Choice, increased 31%, and that relates to the strength of broker-customer relationships. Broker settlements increased 23% in the year, which is said was supported by productivity improvements and buoyant housing markets, and mortgage leads coming from realestate.com.au increased 46%. The group has outlined that it aims to build its next-generation financial services marketplace this coming year as it enhances the digital experience through realestate.com.au and Simpology technology, and the broker experience by scaling coverage, increasing the digital enablement of brokers and driving conversion through lead triage support models. Speaking of the financial result, REA Group CEO Owen Wilson commented, "This has been a defining year for REA, successfully navigating the pandemic to deliver an excellent financial result and to emerge an even stronger business. I'm very proud of our team's ability to respond to the changing needs of our customers and consumers during the pandemic, while also accelerating our growth strategy through a number of pivotal investments. Our flagship site, realestate.com.au, delivers stellar results. Extending its position as the clear market leader in digital real estate and is now Australia's 8th largest online brand overall. Looking forward, the group suggested that while market volatility as a result of COVID-19 lockdowns will continue in financial year 22, experience over the last 12 to 18 months has shown that markets can recover quickly when restrictions are lifted. Despite COVID-related volatility, market dynamics remain strong, with strong levels of buyer inquiry underpinned by low interest rates and healthy bank liquidity, it said, adding that its Australian residential business will benefit from its price increases which came into effect from the 1st of July 2021. REA is entering the new financial year with strong momentum despite ongoing lockdowns. This momentum, coupled with our strategic investments and exciting product roadmap, provides an excellent platform for our continued growth, concluded Mr. Wilson. And the REA board has determined to pay a final dividend of 72 cents per share, fully franked, on the 16th of September. Together with the interim dividend, that represents a total dividend of 131 cents per share relating to the 21 financial year. The 22 financial group result will also include the consolidation of Mortgage Choice and the results of other recent acquisitions and divestments. The Mortgage Choice acquisition was funded through a bridge facility with NAB for $520 million. While this bridge facility matures in July 2022, the group says it is expecting to replace it with a new syndicated facility in the first quarter of financial year 2022. So, standing back, you can see the current winners and the current losers. But if the mortgage industry is crimped thanks to regulatory intervention, because they're worried about financial stability, then that could change the dynamics overall, particularly for those operating in the real estate sector. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.